All right, guys, Meta stock has been hit really hard in the last year and a half, and there's a lot of concerns about its growth potential. I get it. They have 3.5 billion people across all of their platforms active on a monthly basis. WhatsApp, Instagram, Facebook, Oculus, and Oculus is growing. They changed their name from Facebook to Meta because they want to focus on being the Meta company. They want to focus on this virtual reality world. I like it. But at the same point, they're investing $10 billion a year as of now into that business with very, very low, actually negative returns so far. But they're investing in the future. So is now an opportunity to buy? That's a great question. Let's check it out. So let's look at our software. We're going to pull up Meta in our software. And if you belong to our software, you're part of the thousands of people in our community, pull it up. If not, go to everythingmoney.com and check it out. So in the last year, the stock was 381 as a high, 154 as a low. All right, it's currently at 170. So let's go through our 8-pillar process. Now, if you're new to this channel, I'm Paul. I'm a value investor. I use our 8-pillar process as a quantitative way of pre-screening companies. I don't buy 8 pillars and I don't avoid 8 red check marks. My goal to sit there and understand the business from a quantitative perspective. If there's a reason why things are looking poor, I want to understand that. And if there's a reason why things are looking good, I want to understand that as well. So let's start with our 8 pillars. Pillar number 1, we want the 5-year PE of this company to be under 22.5. So on our main page, it says it right here, 17.4. That is a check mark. Last year's PE, 13.7. Pillar number 2, we want the 5-year return on invested capital greater than 9%, 16.7%, another check mark. So what does this mean? This means they are very good about getting a return on the money that's invested in the business through debt and equity, okay? If their return on invested capital is greater than the weighted average cost of capital, then this is a company that's generating wealth for the company, generating actual economic profit. How do you figure that out? It's a complicated formula, but that's why I picked 9%. Because overall in the market, it's between 7 and 8% as a weighted average cost of capital. Pillar number 3, very simply, we want revenue growth over the last 5 years. So I go to our income statement. 5 years ago, they did 47.75. Last year, 120 billion. That is a massive check mark. Now, my theory on Meta is that they haven't maximized their per user revenue, which is why I'm okay with their user growth being stagnant because they still have revenue growth potential and therefore earnings per share potential growth. Pillar number 4, we want net income growth over the last 5 years. So we scroll down here and we look 19 billion to 34 billion. Now, it is lower than last year's, but it's still growth from previous times. Pillar number 5, we want shares outstanding staying the same or going down. Why is that? Well, companies who dilute their owners are punishing the owners who have stuck with them. I don't blame them necessarily if the stock price is overpriced and they issue shares to raise capital, but it does affect stock owners. And a lot of people don't understand this. So we scroll down to the bottom and we look at the end of year 6, 2.9 billion shares. Now they have 2.7. That is a check mark. So they have actually bought back a few shares. Now, when the stock is overpriced, you don't want the company buying back shares. You want the company buying back shares when the stock is cheap. Because when they're allocating the dollars in the company, those are dollars that you own, that you have an ownership stake in. You want to make sure they're investing it at very good returns, which means buying back their shares that are cheap. So that's something as a caveat here when it comes to looking at shares going down. Now, pillar number 6 has to do with long-term debt. We want to make sure a company can manage their long-term debt properly. So the metric I've come up with is very simple. I go to our main page. I look at our 5-year average free cash flow, 24.4 billion. I multiply it by 5. Let's call it 25 billion to be safe, $125 billion. I want the total long-term liabilities to be under 125 billion. And guys, I think for Meta, this is going to blow you out of the water. So we go to the balance sheet. We scroll all the way to the bottom. Total long-term liabilities, $22 billion. They can pay off all their long-term liabilities with less than 1 year of their 5 years of free cash flow. That's incredible. In fact, let's look at this, even better here for Meta. Scroll up to the top. Total current assets is $56 billion. That's cash on hand, essentially. Total liabilities, 44. They can pay off every single dollar they owe to the world with the money in their bank account. Think about how incredible that is. Then that doesn't even touch all their buildings and everything else they own in their other assets. That is incredible. So pillars 7 and 8 have to do with free cash flow. Free cash flow is the lifeblood of the business. The companies can use free cash flow to do one of 5 things: buy back shares, pay a dividend, pay down debt, reinvest back in yourself, make acquisitions. They can do all 5. One of them, it does not matter, any combination. But it's the lifeblood of the business, all right? So in our cash flow statement, first, it's pillar number 7, very simple. We want cash flow growth. So we added this line to our software. It's not available in any other software, even though it's easy. 5 years ago, 17.7. Last year, 35 billion. That is a doubling of free cash flow. So if you remember, previous year, they had 39 billion in profit. This year, 33 billion. But look at their free cash flow. It was 32 billion last year, 36 billion this year. So they had an increase of free cash flow. Our final metric, we want to take their 5-year average free cash flow, and we want to use it to come up with some sort of value for the company. So just like a PE of 22.5, we want to see a price to free cash flow of 22.5. So in order to get that price to free cash flow of 22.5, we take 24.5 billion, multiply it by 22.5. So to be safe, let's call it $575 billion. I don't know the exact number, but call it there. So we want the market cap of the company to be under 575 billion. Well, guys, I don't think that's the case. Let's go back to our main page. And the current, it is. Market cap's 460 billion. Look at that. We won. So let's go to our 8 pillars tab. So all that math I just did, oh my gosh, Meta is an 8-pillar thriller. Okay. So the 5-year PE, 5-year price to free cash flow, around the same number, which we like. Buying back shares, very low debt. Everything here is a check mark. So does that mean you should buy the company?
Whoa.
Pump the brakes. What you should do now is use our stock analyzer tool to determine what to pay for the company. And the reason being is every investment is the present value of all future cash flow. But we don't know the future. We have to make assumptions about the future. So we use a stock analyzer tool to determine those assumptions. Our analyst estimates tab over here can give us some sort of guidance what the analysts who are involved every single day in every single quarter looking at the company think the company will do. So the first thing is we have 56 analysts following the company for this year, 30 for the next 5 years. They're expected to grow EPS, earnings per share, at about low double-digit growth rates. Okay, not bad. Revenue, look at this, same thing. Low double digits. So I sit there and think to myself, wait, everybody's upset about the fact they're not getting much user growth. But look at their earnings per share going up and look at their revenue per share, the revenue total going up. This is kind of the play on Meta if you like it. Are these numbers reasonable? Now, in our stock analyzer tool, we are using these revenue growth and profit margin numbers to determine a price to pay. Okay. Now, I like to do a 10-year analysis. Those analyst estimates were for 5 years. So I think you want to go a little bit less than those because as the company grows, it'll be harder to grow at a higher rate. So first things first, revenue growth numbers. And by the way, please watch the stock analyzer part over and over because this is the most popular part of our website. When I look at the data of what people use the most, this is what they use the most. When we're in our chat and people talk to me, Paul, what do you think? I say, hey, show me your stock analyzer assumptions. That's what I always go to. All right. So revenue growth, low double digits to the high end. So I'm going to go with 4, 7, and 10 over a 10-year period. Profit margin. Now they are spending a lot of money on this Meta. So I think it's going to drive down margins a bit. So I'm going to go with 24, 27, and 30. Free cash flow, I'm going to do the exact same thing. Now PE. Now guys, the PE and price to free cash flow is based on at the end of 10 years. And the reasons to pay a high PE are moat, which would be reflected in its ROIC, return on invested capital. Can they deploy their capital, high rates of return? The better the moat, the more likely they are to do so. And also growth potential. Do they have a lot more growth potential? Well, in 10 years, they're going to be a lot bigger company, right? So it's going to be harder for them to grow at a higher rate. So at that point, they'll basically be a blue chip company. So I'm going to assign a much lower PE and price to free cash flow. I'm going to do 13, 15, and 17. Because if the Meta takes off and they'll probably have a lot more growth potential, I'm okay paying 17 to 20 times Actually, that's a good point. Let me do that. Let me do 17, 13, 16, 19. Because if Meta takes off, it'll be in the next 10 years, and that'll give them a lot more potential for growth. So I'm willing to pay a much higher premium. Now, finally, my desired annual return. This is essentially my margin of safety. You can get 9 or 10% by investing in a long-term ETF. So for desired annual return, give yourself a higher annual return. That drives the price lower. For margin of safety, I always start with 12.5%. And as I go higher in terms of my assumptions, I go higher in terms of my desired return. Why? Because these are less likely to happen, so I want more margin of safety, right? I'm making much better assumptions, and on the low side, I'm making much lower assumptions. So the stock's currently at 170. I'm hitting the analyze button. 6 numbers are going to pop up. They're going to be 6 numbers are going to be 3 numbers based on values of earnings, 3 numbers based on price of free cash flow. If they're all green, that does not mean go out and buy. What it means is go out there and make sure these assumptions are correct. How do you do that? Do your research. It's very simple. Go out there and see the pros and cons of what people are saying about the company. But most importantly, join our community. We have thousands of people in our community that are constantly researching. And this is the reason why we created it, because it's much, much easier to be a value investor when the groups of people are together talking about it. Being a value investor can be a lonely road, but I believe everybody should be a value investor. Why? Because you don't want to overpay for future assumptions. So be reasonable in your assumptions. Go out there, join this community. It's less than a cup of coffee per day. Everythingmoney.com. Please check it out. Our assumptions, boom, look at this. We have a low of 133, a high of 230, and a mid price of 175. So I think you should go do more research if these assumptions make sense to you. And if you like this video, please watch our next video on margin of safety so you can understand more about how I look at it. And don't forget to subscribe to our channel. Thank you very much for your time.